Exchange traded funds or ETFs allow investors to buy a collection of stocks or other assets with just one fund. And just like stocks, they trade on a similar exchange like the TSX. ETFs have become tremendously popular, especially in the last decade. And now they hold trillions of dollars in assets. With thousands of ETFs to choose from, where does an investor such as yourself, where do they get started? In this video, I'll cover the best dividend ETFs you can buy right now. And I'll also cover some very highly specialized funds for you to choose from. Let's dive right in. The first ETF we're going to look at is the Purpose Bitcoin Yield ETF. And the purpose of this fund is that it's the world's first yield-focused Bitcoin ETF. That means you don't need any wallets or any additional signups required. You can earn a yield or a monthly distribution by getting exposure to Bitcoin. And this is eligible for TFSA and RRSP. That means tax-free or tax-deferred compounding. And it's also TF and RRSP eligible. That means tax-free or tax-deferred compounding. When you hold Bitcoin or other crypto assets directly, they are ineligible for tax-sheltered gains. And if you look at on the right-hand side, you can see why investors are looking at these ETFs. Just look at the yield from 18% all the way to 23%. The difference is that this ETF comes in three flavors. You can have a FX hedged version, a non-FX version, or an ETF that tracks Bitcoin that trades in USD. All three ETFs have similar management fees at 1.1%. And how much is this ETF trading for right now? It's only trading for $5 a share. That means for $5 a share, you can pick up as many as you want and get a yield of around 17 to 18%. Now, this asset is very volatile. As you can see, the year-to-date return is minus 38%, which makes sense because everything is getting hammered right now, especially the tech sector. Year-to-date basis, it was trading for around $8.52, and now it's trading at just over $5. Now, depending on your risk profile, this is either super undervalued and you can pick up a 18% yield for about $5 a share. Or you can see and watch where this goes. If it goes up any higher, maybe it's a better option for you. It just depends on your risk profile. This is a highly volatile, highly risky ETF. That's why you're getting paid such a high yield premium for that risk exposure. So if you wanted to throw a couple $100, whatever you're comfortable with, and lock in that 18% yield, that might be one option. Or you can put this on your watch list and see where this goes. As you can see, that as Bitcoin has gone down, where it was trading roughly for about 47,000 per Bitcoin, and now it's jumped by 29,000, this ETF similarly has gone down a similar path. As Bitcoin goes up, this ETF will do the same. As this goes down, this ETF will do the same. Let's take a look at the portfolio breakdown. As you should expect, because this is a Bitcoin-focused ETF, 98% of this ETF holds Bitcoin. The rest is probably some leftover cash. And not only is this a Bitcoin-focused ETF, but it's also a covered call yield-focused ETF. That's why the exposure to covered calls at 54%. And you can see exactly when some of these short calls are expiring. So in less than a month, 93% of these short calls expire. Taking a look at the distributions, as you can see since inception, it has paid a dividend, a monthly dividend, between 10 to 7.5 cents per share on a monthly basis. And taking a deeper look at this ETF, how does it work? Well, it purchases Bitcoin ETF, and then it generates yields in addition to long Bitcoin as a component of total return. In other words, you benefit if the value of Bitcoin goes up. You benefit as these covered call options are sold, so you get that monthly distribution. As you can see on this graph on the right-hand side, here's your P&L, your profit or loss, and based on how Bitcoin goes up, you get to benefit from that premium and the price appreciation of Bitcoin. So if you are interested in this ETF, there are three different ticker symbols. You can choose from FX hedge, non-FX hedge, or USD, BTCY, BTCY.B, and BTCY.U, based on the flavor you prefer. And if you want to learn even more about this Bitcoin ETF, there is a tab for FAQs, so you can learn even more about how covered call ETFs work. How is the income or yield generated? How will you be taxed if you hold the Bitcoin ETF? How does this ETF hold or spot crypto? And other FAQs you should read through so you can learn more. So here's some quick takeaways for this ETF. It's a high yield monthly distribution focused ETF. You get tax sheltered exposure to a monthly yield through covered calls and Bitcoin as long as you hold it through your TFSA or RRSP. A couple of downsides is that it does have a high expense ratio, which is a straight up deduction against your total return, and the MER ratio for this particular ETF series is 1.1%. And last but not least, Because you get such a high yield and a monthly distribution, it does come with risk. And that risk is that you're tracking a highly volatile asset in cryptocurrency. If crypto goes up, you benefit. If it goes down, you also have some downside risk. But before you consider adding this series of ETFs to your portfolio, make sure you understand all the risks around cryptocurrency and covered calls. Next ETF we're going to talk about is ZUT, or the BMO Equal Weight Utilities Index ETF. Taking a quick look at the strategy, this ETF is designed to replicate to the extent possible the performance of the Selective Equal Weight Canada Utilities Index. Benchmark info, and this particular index consists of securities or stocks that are classified as utilities. In addition, each security or stock in this index is allocated a fixed weight rather than a market capitalization. In other words, if this ETF were to hold 5 or 10 stocks, they would be split equally. So let's say if you had a basket of 10 stocks, they would each be split at 10%, rather than each stock being weighted by the size of its market capitalization. This index ETF is rebalanced semi-annually in March and September. To be included in this ETF, the stock selected must meet a certain trading volume. So these are liquid assets. And the major benefits of this ETF is designed for investors looking for growth solutions, exposure to Canadian utility stocks. They're equally weighted and professionally managed by BMO Asset Management. Let's take a look at the overview. What are some of the key facts? The ticker symbol is ZUT. It has about $500 million of assets under management. The last trading price was around $26.52. The yield on this ETF is just under 3.5%. The management fee at 0.61%. And it pays a distribution on the monthly. It's been around since 2010, so about 12 years or so. And it's eligible for your RRSP, RRIF, RESP, DPSP, and of course, TFSA. How risky is this ETF? It's classified as a medium risk. Take a look at the price and performance. Since inception, if you had invested $10,000 when this ETF launched back in Jan of 2010, that $10,000 would be worth roughly $30,000 today. That's a 3x return. Not bad for just holding a basket of safe Canadian utility stocks. If we take a look at the annualized performance, this ETF has delivered a 9% annualized return. Take a look at the holdings of this ETF, you get exposure to 16 different Canadian utility stocks. And there, as you can see, they're all equally weighted either between 7.5% to 6.5%. And you should recognize some of these names that are major names in Canadian utilities, such as Transatlantic Corp, Capital Power, ATCO, Canadian Utilities, and so on. In terms of its geographic allocation, no surprise, it's a 100% Canada-based ETF. In terms of sectors, you get exposure within utilities to 30% renewable electricity, multi-utilities at 27%, 21% at electric utilities, exposure to gas utilities and independent providers. In other words, it's a well-diversified utility index ETF focused in Canada. And right now, the stock is trading roughly around $26.50. And with the way the market has been going so far on a year-to-date basis, everything has been down except funds like this. It's actually up 5% on a year-to-date basis. So if you were to compare ZUT and the TSX on a year-to-date basis, the TSX is down 5% while ZUT is up 5%. Let's quickly summarize ZUT. Exposure to 16 different Canadian utility stocks with just one ETF. And the MEI ratio, I wouldn't say it's too high or it's not too low. It's sort of in the middle at 0.6%. And don't forget that monthly yield at 3.5%. That's a very good yield considering you're only holding a basket of 16 stocks. And in terms of the yield, it's a pretty safe yield around 3.5%. As utility stocks generally aren't known for cutting their dividends, they're generally very stabilized dividend players. As you saw, the average return for this ETF is over 9%. Compare that to TSX at 8%. Just one recommendation, as amazing as this ETF may sound, don't just make this your entire portfolio. You need to diversify just beyond Canadian utility sectors. This is a very highly specialized fund, so it's good to get some exposure, but 100% of your portfolio should not be ZUT. And my goal with these ETF videos is to bring you the best ETFs to choose from that give you growth, that give you dividends. If you don't want to miss out on the next feature of my ETF series, make sure you hit that like, subscribe, and thanks button. It lets me know to produce more content like this, and you don't miss out on future content. Next ETF we're going to talk about is the iShares Global Agriculture Index ETF, ticker symbol COW or COW. And the net asset value or NAV is currently priced at roughly $71.37, and it is up on a year-to-date basis just under 14%. Compare that to the TSX, which is down 5%. And why would you want to invest in cow? Because you get exposure to companies involved in the production of agriculture products, fertilizers and agriculture chemicals, farm machinery, and packaged foods and meats. You get exposure to equities and equity-related securities of US and global companies worldwide involved in agriculture. And it's a great way to diversify your portfolio and express a view on the agricultural sector. And the benchmark index it focuses on is on the Manulife Investment Management Global Agriculture Index. In terms of performance, on an average annualized basis, it has delivered a total return of just shy of 11%. That's actually a very strong return over the long run. That's honestly a big check mark if you can see that type of growth over the long run. And if you had invested in this fund when it launched, that $10,000 would be worth over $40,000 today. That's amazing growth in that time span. Take a look at some key facts. It has assets under management of $430 million. It rebalances quarterly and has 36 different stocks in this one ETF. And it's trading around $71 per share. And it's been trading around 2007, so it's been around for about 15 years or so. In terms of portfolio characteristics, it pays out dividends on a semi-annualized basis with a yield of 58 basis points. The last distribution was just under $7 a share. And for those of you that are interested in an ESG fund or environmental social governance fund, it has a AA rating. And the reason why it has such a good MSCI ESG rating because it's not involved in either controversial weapons, nuclear weapons, civilian firearms, tobacco. It has no UN global impact, no thermal coal, no oil sands, giving it a 100% involvement in MSCI ESG sectors. In terms of its management expense ratio, it's roughly 72 basis points, and the risk factor is at medium. In terms of its holdings, it is weighted by market capitalization, meaning bigger the company, the higher the weighting in the ETF. So as you can see, these are some of the biggest names in the agricultural sector. Corteva, Archer Daniels, Tyson Foods, Tractor Supply, and this list goes on. And the top 3 names in this ETF make up roughly 30% of its holdings. In terms of geographic exposure, 80% comes from the United States, 7% from Italy, and about 4.5% from Canada. And taking a look at the sector breakdown within the agricultural space, 38% is based on fertilizers and agricultural chemicals, 22% is based on agricultural products, and 17% is based on agricultural and farm machinery. This ETF has grown tremendously over the past few years, trading from roughly $28.75 all the way to $75, $71 right now. Taking a look at what's been happening in the market recently, it's actually trading a good discount where it was at $77 and dropping all the way to $71. So if you are interested in picking up this ETF, now may be a time as it's trading in the low 70s. And if you were to compare this ETF to the TSX in the last year, this ETF has gone up 14%. Compare that to only 3% for the TSX. Let's recap why I like CFW. You get exposure to the best US and global companies focused on the agricultural sector. This ETF has delivered an 11 to 12% annualized average return since inception, much better than that of the TSX. You get exposure to the 36 best companies in this agricultural space. You don't have to choose these companies yourselves, it's done for you. And for those of you interested in the ESG space, this is rated very highly on that ESG scale. Next ETF we're going to talk about is the iShares S&P Capped Energy Index ETF, or XEG. Moving all the way from agriculture to energy. The NAV is currently priced at roughly $16.40, and on a year-to-date basis, this ETF is up 55.63%. Because why would you want to choose XEG? Because you get exposure to companies in the Canadian energy sector, and you can express a very sector view on your portfolio. And the investment objective is for long-term capital growth by replicating the performance of the S&P Capped Energy Index. In terms of performance, since inception, it has delivered an annualized return of 6%. If you had invested $10,000 when this fund was launched, it would be worth just shy of $40,000 today. Taking a look at some key facts, this is a very popular ETF as it has roughly $2.4 billion of assets under management. It rebalances quarterly and has 24 different companies in this ETF. And it's trading at roughly $16.40, and it's been around since 2001. Taking a look at the portfolio characteristics, It has a yield of 1.29%. The last distribution paid was 8 cents per share and has a yield of 1.84%. And how often do you get those dividends? Well, those dividends are paid on a quarterly basis. And the sectors are fully compliant with MSCI ESG sectors, so no controversial weapons, no nuclear weapons or firearms or tobacco. You have 69% to oil sands, no thermal energy, and no UN Global Compact violations. In terms of its MER ratio, it is at 61 basis points. And how risky is this ETF? Well, it is all the way on the high end of the spectrum, which makes sense because energy is a very cyclical sector. If the world is moving, there's demand for energy, it's going to grow. But in times when there are lockdowns, when there's no travel demand, when there's no energy demand, it falls down really fast. And with the conversion to renewable energy, it'll be interesting to see how this exposure, this sector, grows in comparison. In terms of its holdings, it's also weighted by market capitalization, meaning Suncor itself makes up 26% of this ETF. Canadian Natural Resources, another big name, makes up 22% of this ETF, and Cenovus Energy makes up 12.81%, and all the rest make up between 8 to 2% of the holding. In terms of sector breakdown, there are two main sectors within this energy space. 54% is in oil and gas exploration and production, and the rest 45% is in integrated oil and gas. And if you were to compare XEG to the TSX on a year-to-date basis, the TSX is down 5% and XEG is up 49, close to 50%, smashing the return of that of the TSX. So if your portfolio had ZUT, all the ETFs essentially I covered this far, your portfolio would actually be up compared to the rest of the market that's in shambles right now. So let's recap why I like XEG. Similar to how ZUT was focused on Canadian utilities, XEG is focused on Canadian energy. It's been around since 2001, that's over 21 years, and has delivered a rate of return annualized at over 6%. And you get the benefit of holding the 26 best companies in the energy space with just one ETF. And last but not least, don't forget you have a quarterly distribution at just around 2%. And at this point, you'll be wondering what's the best way to keep track of these amazing dividend ETFs that I've covered in this video, or other dividend videos that I've made so far. Well, you can now download my custom-built dividend tracking spreadsheet that I've designed for investors like you. You can keep track of your dividend income, your gains, your losses, and even forecast your future dividend income that I've built from the ground up for, again, investors like you and I, because I couldn't find another solution that fit the bill. And I use this spreadsheet to figure out what my dividend income is going to be like, what should I be holding, what should I be buying, and is there something that I need to sell for other opportunities. So make sure you check out the link in the description below and download a copy today. The next ETF we're going to talk about is ZLB, the BMO Low Volatility Canadian Equity Index ETF. No surprise, this year has been super volatile with markets crashing almost every single day. How do you get the benefit of the stock market while minimizing your exposure to that volatility? Well, here's your answer. The answer is a low volatility index ETF. Ticker symbol ZLB, we just talked about. It is a very popular ETF, as you can see, with assets under management of just shy of $2.7 billion. And it's trading just under $40 a share. And the annualized distribution yield is 2.62%. In terms of its MER ratio, a very low and effective MER at 0.39%. And it pays dividends on a quarterly basis. And it's been around since 2011, or about 10 or 12 years so far. Let's talk about the portfolio strategy. It's designed to provide exposure to a low beta weighted portfolio of Canadian stocks. Beta measures the security's sensitivity to market movements. As you can see this year, the market has been very, very volatile. This ETF utilizes a rules-based methodology to build a portfolio of less market-sensitive stocks from a universe of Canadian large companies. In other words, this ETF is designed to look at all the stocks that trade in Canada, but take out the ones that are super volatile, so essentially you're left with a basket of stocks that are generally less sensitive to the market. The main benefits of this ETF is designed for investors looking for growth solutions and diversified to Canadian equities. And it consists of Canadian equities with lower volatility than the market. And, of course, managed by BMO Global Asset Management. How risky is this ETF? Well, compared to XEG and all the other ETFs I've covered, this is considered low to medium risk. And if you had invested $10,000 in this ETF when it launched back in 2011, that $10,000 would be worth close to $35,000 today. That's a pretty good return in those 10 years. If you annualize that performance, that is a 12.76% return. Compare that to the average TSX return of around 8%. But theoretically speaking, maybe you're better off holding a basket of stocks that are less volatile. You get a smoother return than holding the TSX in general. Take a look at ZLB's holdings. It has 47 different stocks in this one basket, and it is also weighted by market capitalization, the biggest name being Hydro One at 5%. And these are all names that are generally considered very stable compared to the rest of the market. Well, you'll see names like Fortis, Emera, Metro, Intact Financial, Loblaws, Empire, and utilities that make up bulk of this ETF. In terms of geographic allocation, no surprise, 100% Canada. And you actually get a very diversified sector allocation as well. 21% from financials, 17% from utilities, 15% from consumer staples, 11% for communications. Take out the volatility, and this is the basket you're left with. Let's compare ZLB to the TSX. As you can see, ZLB is down on a year-to-date basis, roughly 2%, where the TSX is down close to 5%. Let's recap why I like ZLB. You get exposure to 47 of the best companies in Canada that are considered to be less volatile than the rest of the TSX. You get an amazing quarterly dividend at roughly 2.5% yield. And don't forget, it's been around since 10, 11 years, and over that time span, it has delivered an annual return around 12 to 13%. Low volatility, great dividends, and steady capital appreciation. This is all the factors you need for us to be a cornerstone holding for your portfolio. And last but definitely not least, this is another very specialized ETF called the Desjardins RI Emerging Markets Low Carbon Emissions Index ETF. This ETF is designed to give you exposure to emerging market equities, one that integrates environmental, social, and governance considerations. And the companies included in this ETF are focused on reduction in carbon intensity. If you're looking for a responsible investing approach that does not compromise on returns, this is a checkmark. Taking a look at the market information for this ETF, the ticker symbol is DRME, and it trades on the TSX. Unfortunately, this ETF has not been around long enough to see long-term growth trends, so if you had invested $10,000 since inception, you would actually be down to $8,000 today. Considering the entire market is down, this makes sense because of rising interest rates, fears around Ukraine and Russia. There's a lot of factors why you would see it actually decline, just like the rest of the market. But again, the benefit is if you're focused on emerging markets and low carbon emissions. So taking a look at the fund details, this is focused on emerging markets equity. It's been around since 2021, so just a little over a year. It has about 100 million assets under management. The MER ratio is at 39 basis points. It has 362 different stocks in this ETF, and the yield is at 2.64%. And it pays out dividends on a quarterly basis. The last dividend was 13 cents per share. And it's also rebalanced on a quarterly basis. The risk rating is at a medium level. Taking a look at some financial data for this particular ETF. And because there's limited market information, you can only go by on so much information. So for example, on a year-to-date basis, it's down 10%. Or if you were to compound that, it's down 14% since inception. Taking a look at sector allocation, even though it's focused on emerging markets, the sector allocations is still focused on technology and financial services. Those are the top two sectors. From energy all the way to cash, you can see it goes from 7 to 0.6%. In terms of geography, the biggest weighting comes from China at 24.65%, Taiwan at 24%, and Korea at 15%. That makes up your big three. And you get exposure to India and South Africa at 9 and 5%. Some of the top 10 holdings include Taiwan Semiconductor, Tencent Holdings, Samsung, Reliance Industries. These are some of your biggest companies that make up most of this portfolio. The one thing about this ETF is if you are from around the world, you're living in Canada, let's say if you are from China, Taiwan, Korea, India, etc., and you want exposure to companies you would have seen back home, this is one way to get that exposure. This is an ETF that I wouldn't rush out into the market and try to pick up as many units as possible. This is one that I would sort of wait and watch and see where it goes because it's relatively new in the marketplace. But there are some reasons why I actually like DRME, and it has some good prospects. One, it's focused on low carbon emissions around the world, especially in emerging markets. And this ETF takes a very responsible investing approach, which focuses on companies that are trying to reduce carbon emissions. Not only that, but you get the benefit of holding companies and countries that are considered emerging market, all while sitting at home, while this particular ETF trades on a TSX. In other words, you get the benefit of holding global companies in emerging markets while benefiting from holding a Canadian ETF. And last but not least, you get to benefit from a quarterly distribution at just over 3%. Now, before you invest in any stock or ETF that I've even covered in this video, it's super important to make sure you do your homework and your due diligence. I would actually use these videos that you find on YouTube, TikTok, Instagram, whatever, as just a starting point. So whether you hear about a stock or an ETF from any other content creator, there's no shortcut for doing your own homework, your own due diligence. And that's what I'm always preaching on this channel. Give you the tools, give you the knowledge so you can analyze ETFs and stocks that make sense for you. And if you want to use Wealthsimple or Questrade to trade these ETFs just like I do, you can actually use the links in the description below, sign up for Wealthsimple or Questrade and pick up a $50 sign-up bonus. That's enough to get you one of these ETFs that I covered in this video for free. Or in other words, that $50 will get you 10 different shares of that Bitcoin ETF, all for free, just for signing up. Thank you so much for watching. Consider signing up for that channel membership to get behind the scene updates and provide direction for future content. It's only for less than $5 a month and it would be a big help for signing up. And while you're at it, make sure to hit that like, subscribe, and thanks button. That's all for now. I'll talk to you in the comments section.